Thank you so much, everyone, for joining. My name is Stephanie. I'm here with True North Business Funding. At True North, we help buyers finance their way into business ownership. So from the first conversation all the way through closing, we're here. And today we're going to be digging into business acquisitions and separating fact from fiction. If you've spent any time researching how to buy a business, you've probably run into a lot of information out there, and some of it's accurate, a lot of it's not. So it's usually the wrong information that will get buyers into trouble. And it's not because you did anything wrong, but it's because they walked into a conversation with a lender or a broker and they're expecting one thing and they get hit with a completely different subject or topic. So today, we're going to walk through the most common misconceptions that we hear from buyers and then tell you what the lenders are really looking for based on what we're seeing in everyday transactions. One quick housekeeping item before we start. The session is being recorded, so if you'd rather sit back and listen rather than take notes, we'll send you the recording in the presentation afterwards. But if questions come up as we go, please drop them in the chat. We'll leave some time at the end to work through as many questions as we can. As for the agenda, I think a decent amount of you have seen the agenda today. But let's talk about what we'll be reviewing. So first and foremost, we'll be talking about down payment. How much do you need? Secondly, transferable skill set and transferable knowledge. What really actually happens if you want to buy a business outside of your current industry. Third, citizenship and SBA eligibility. For reference, there has been a policy change here, so everyone really should be aware of what's happening on the SBA level regarding citizenship. Fourth, we'll chat about post-closing liquidity, because this one tends to trip up more buyers than almost anything else, and mainly because it's a requirement that people just don't really know exists. Fifth, passive income. How much hands-on involvement ownership really takes and how much hands-on involvement lenders are expecting. And then from there, we'll spend a few minutes on why customers choose to work with us and close it out with an open Q&A. So, another reference point. Most of today is built around myth busting. So for each topic, we'll show you a misconception like you're seeing on this third slide, and then we'll show you what we hear the most, and then we'll walk through what the actual lender criteria looks like. So our hope is by the end of this that you're going to walk away with a much clearer, more realistic picture of what it really takes to get a deal financed into the finish line. So for our first topic, we're going to start with the one that most buyers really want to know, and that's how much money do you actually need and how much money do you really need to put down? The myth, and it's completely understandable because it's everywhere online, is that you can buy a business with little or no money down. A lot of times it's framed as creative financing online. And you'll hear on social media or LinkedIn or whatever it might be about buyers who did it, and they bought a business with none of their own capital supposedly, and I completely get why that's appealing. But when we sit down with lenders, it's not traditionally rooted in reality. So for an SBA loan, which is the most common financing vehicle for these types of transactions, lenders really want to see a minimum equity injection of about 10%. This is assuming the seller is willing to hold a note for another 10% of the deal. They describe this as having skin in the game for both you and the seller. Now, there is some flexibility there. So if a seller agrees to hold a note and puts it on full standby, meaning that there's no payments to the seller during the loan term, that note can satisfy up to half of your required equity injection. So instead of needing the full 10% in cash, structuring the deal in a different way can lighten that load. Now, that said, I want to be upfront about something. This will only work if the seller agrees to it. And full standby usually isn't a seller's preferred outcome, because you're waiting on them, or you're asking them to wait on their money. It's something that you will need to negotiate as a part of the deal. And traditionally in competitive environments, where there's multiple offers, it can weaken your negotiating position. Just a fair warning. Um, Last but not least, in the reality section, you'll see that gift funds are permitted. So if a family member or, a friend wants to help you get into the deal, it is allowed, as long as there's a signed gift letter from the giftor documenting everything. And generally, these gift funds will not need to season as long as the letter, is acceptable by the lender. So what's really important to remember here is that 10% is traditionally the absolute minimum. And it's assuming that the seller note is a part of the structure. It's not zero, but it's certainly more attainable than some people assume once you understand how these pieces fit together. And the one caveat, though, is that 10% is really specific to SBA 7A financing. So if you're going the conventional loan route or structuring more of the deal through seller financing, that minimum certainly can climb higher, and sometimes well beyond 10 or 20 or even 30%. So the actual down payment number really depends on how the deal gets put together. But SBA financing, traditionally 10% is the minimum expectation. All right, so transferable industry knowledge. Here's one that it tends to come up more than you expect, and buyers assume that because they have an MBA or advanced schooling or other entrepreneurial experience, that alone will make them eligible for financing. And in fact, it doesn't, or not by itself. An MBA or a business degree is great. I mean, it teaches real valuable skills, financial analysis skills, strategy, management theory. But lenders aren't expecting to check a box for education. They're looking for something specific and practical, especially experience-wise. So first, management experience. Meaning, have you led teams before? Have you owned a business before? Even if it's in a different industry or a different kind of business. That track record will tell the lender that you understand the fundamentals of running a business or an operation, even if the industry is new to you. Second, transferable skills. This is quite honestly the most important criteria that we really see that lenders are expecting. Maybe transferable skills meaning like you haven't run this specific type of business before, but maybe your career shows that you've operated a similar structure, that you've worked with a similar customer base, or you've been in a similar industry, or worked in a similar operating model. All of that carries significant weight. And then lastly, key employee retention. So meaning if there's an experienced manager or team already in place who's staying on after the sale, that certainly offsets some of the gap in your background. It doesn't replace the need for transferable skills entirely because the lender still wants to see that you personally are bringing something relevant to the table, but by retaining some of the key employees helps to mitigate some of that lender risk. One important flag, you'll see this in yellow at the bottom of the slide. If you're looking to require a business that requires specific licensing, think like businesses within the trades, food service, alcohol, medical, regulated services of any kind, even transportation, you will need a clear documented plan for how that gets handled after closing. This is not optional, and lenders are very strict on it. So when they ask, you'll need a solid answer on how you plan to obtain that licensing. And so certain industries, like you think HVAC, plumbing, electrical, those are typically my examples I provide to buyers. Lenders typically are more strict on transferable skill requirements for those types of businesses because they do require a certain skill set and a certain level of licensing, whether it's a master's license or whatever it may be. So there is more scrutiny from lenders on those types of businesses, especially with licensing. So current SBA requirements on citizenship. And this one's important because it's new and there's been a meaningful policy change that affects a specific group of buyers. Effective March 1st of this year, lawful permanent residents, also known as green card holders, are no longer eligible for SBA financing. And that's a significant shift from how things were working previously. And if you've been researching this for a while, you may be working off of outdated information, but it's something that everyone should know. So currently, who is eligible for SBA financing? U.S. citizens. U.S. citizens have full eligibility across all SBA loan programs. Same with U.S. nationals. And regardless of your status, the business that you're acquiring has to be a for-profit US-based business. There's no, that is a non-negotiable. On the other hand, who isn't eligible, and as of March 1st, lawful permanent residents, LPRs, can no longer hold any ownership interest tied to an SBA loan. And this is new. We don't know how long this is going to last. We don't know if this is a permanent decision from the SBA, but all we know is that it is in effect right now, and we have to abide by those laws or those regulations. Non-permanent visa holders such as like H-1B, L-1, E-2, similar visa holders, they were already not eligible for SBA guaranteed loans, so that piece hasn't changed, but they are not obviously eligible for SBA loans. So now if you fall into either one of those categories, the door isn't completely closed for you in terms of a business acquisition, because conventional financing still likely applies. Non-SBA lenders tend to evaluate lawful permanent residents and visa holders on a case-by-case basis. So it's a different process, and likely there will be different terms. But if any of this applies to you, we'd love to have a conversation with you directly just to walk you through it and let you know what's realistic given on your specific situation and what we've seen and what our lending partners are willing to work with. All right. So next one is post-closing liquidity. So this is a requirement that I mentioned earlier, catches a lot of people off guard, and mostly it's because nobody tells them about it until they're already pretty deep into the process. So the simplest way to think about post-closing liquidity is it's the cash and liquid assets that you still have left over after everything's paid. This includes your down payment, closing costs, fees tied to the deal. Post-closing liquidity is a completely separate requirement from the equity injection itself. One thing in particular that I've encountered is that buyers tend to assume that those are the same bucket of money, and they're not. So what counts here? Checking accounts, savings, money market accounts, CDs, marketable securities, stuff that's generally liquid, meaning you can access it quickly if you needed to, is what counts towards post-closing liquidity. Quite honestly, cash is king here. Lenders love to see cash. Retirement funds, on the other hand, are a little bit more nuanced. So your 401k, IRA probably count, but there are conditions attached. So that is a conversation you should have directly with your lender rather than assuming one way or another. On the other hand, what doesn't count? Home equity, illiquid real estate, business assets, collectibles. None of that stuff will count towards your post-closing liquidity, even though it does truly represent real value on paper. Lenders don't look at it that way because it's not, you can't easily liquidate it. So our suggestion to you is to plan ahead. Avoid making large cash movements before closing. Make sure your funds are seasoned. And by seasoned, I mean about 2 bank cycles or 60 days. So you want your funds to be sitting in your accounts for about 60 days or more. This is generally enough that a lender isn't going to ask a lot of questions about where did this money come from. And then the typical requirement or benchmark that we're looking for, lenders are looking for, is 10% of the total purchase price. And that needs to be remaining in liquid assets after close. So that number can vary based on the lender's discretion. But it's a solid planning figure to work with from the start. And the 10% liquidity, if you're putting more of an equity injection in or the seller's holding more of a note, that's when you'll see that figure maybe variate a little bit. So it's not set in stone, but it is a general benchmark to work with, like I said. All right, passive income. Is buying a business truly hands off? And this is another one that everyone has seen on social media and online. You see a lot of anecdotes about someone claiming they bought a business and it runs itself now, or it's generating passive income with barely any work. And that's really rarely how it goes. And again, I get the appeal of this one, but a lot of buyers picture themselves stepping into ownership, hiring a manager, collecting a check. But especially for what we consider Main Street businesses, active ownership is the expectation, not the exception. So lenders and sellers expect the new owner to be genuinely involved in day-to-day operations, whereas passive ownership does happen, but it is the rare exception. It's not the standard model that these loans are built around. So if your plan is to hire a new manager, a new manager meaning someone who isn't factored into the cash flow already, to run things for you, that cost comes directly out of the business's cash flow. So really, the business has to be generating enough cash flow to pay this manager's salary, service the debt, and still leave you, the new owner, with enough compensation or reasonable compensation to top it all off. So this brings us to the number that kind of governs it all. Lenders require a minimum of 1.25 for the debt service coverage ratio. So if you're adding a new manager salary into this mix, that cost will eat into the cash flow that's available for the debt service and your owner's draw. So it's not that passive ownership isn't possible, but really the math has to work for it to make sense. And it typically requires a stronger performing business to support that extra layer of cost. All right. So since I mentioned debt service coverage and DSCR, I really do want to spend a couple minutes into understanding it, because this really is one of the most important figures and numbers in business financing. And it determines whether a lender is willing and comfortable to move forward with the deal. So the formula is pretty simple. Debt service coverage ratio equals net operating income divided by total debt service. Let's dive into what those mean. The net operating income is the cash flow that the business is expected to generate under the new ownership. So this is after operating expenses, but before any debt payments. Lenders will typically build this from the debt service, or I'm sorry, from the seller's discretionary earnings, plus any owner's add backs that they're willing to accept, minus your new salary or compensation as the new owner. The total debt service is the principal and interest payments due across a 12-month period. So this includes your acquisition loan, which is usually a 7A loan, a real estate loan if applicable, and any seller notes that aren't on full standby. So two quick examples below. We have example A, where the net operating income is $175,000. The total debt service is $130,000. Divide those by each other and you get a 1.35, which meets the minimum. This deal on paper technically works. Example B, you have a net operating income of $148,000 and a total debt service of $155,000. That comes out to a 0.95, which is below that 1.25 threshold. So the deal as structured technically doesn't work. But here's why we want you to sit with example B. It's not a dead deal. It needs restructuring. So maybe for example B, the purchase price needs to come down, or maybe more seller financing needs to go on standby to reduce the debt service number. Or maybe you as the buyer need to bring more equity to reduce the loan amount. So really what's important to take away from here is just because the debt service coverage ratio is below a 1.25 doesn't mean the deal won't work on paper. So this is really what we do a lot of at the core. We look at a deal like example B and we figure out what needs to change in structuring it to get it into the example A territory. Perfect. So at this point, you've heard a lot about what lenders require and what their expectations are. So I do want to spend another couple of minutes on why buyers choose to work with us to help navigate everything. So first, our lending network. We work with a broad range of SBA preferred lenders, community banks, conventional financing sources, and we match buyers to lenders who are the best fit for their specific transaction and their specific needs. Second, we do an acquisition analysis. So before a business even goes to market, especially with the Sunbelt team, we often already are looking at the debt service analysis and financing terms alongside the sellers and the brokers. So when you, a buyer, comes to the table, the groundwork is already established. Third, your time. We work to prepare buyers before they make an offer because what we see is that financing delays are one of the most common ways that deals will fall apart or lose a lot of leverage. So getting that preparation done up front will protect your timeline and your negotiating position. And lastly, results. We've helped to fund over $250 million in transactions. We've closed more than 250 loans. We truly know what lenders want to see, and we know how to position your opportunity to get it in front of the right person. So with that said, I do want to open it up to any questions. So if you got a question, feel free to drop it in the chat, which should be the Q&A section of the Teams. You'll see a little tab up either at the top or the bottom of your screen that says Q&A. So if you do have a question, feel free to drop it in. And while we're waiting for questions to funnel in, I want to thank everyone for their time today. I think we were a little bit more timely than we allowed, but the one key thing we really want you to take away is that buying a business is doable, and we're here to help you with that. And if you're actively looking or even just starting to think about a business acquisition, the next best step with you, the next best step for you is to schedule a time to chat with our team or to schedule a financing estimate with our team. And the financing estimate conversation is where we will help you to understand your actual buying power and what size of deal you could realistically finance before you even make an offer. So we find that these financing estimates tend to put you in a stronger negotiating position, and it helps to save your time from chasing deals that might not work or deals that may not pencil out. So I thank you guys again for your time. I'll hang around for a couple more minutes for any questions. If you have any questions that you don't want me to address online and you want to chat one-on-one, feel free to email us at team@tnbfunding.com. Otherwise, you can reach out to me directly. You'll see my partner, Keith Payne. He's on the slide too, but we work as a team together. So any emails you send the team, he'll get them too. And then, yeah, again, feel free to reach out to us. I don't think we have any questions this time. So, again, if there's anything that pops up after we leave here today, happy to hop on a call with any one of you or schedule a Teams meeting.